Excellent. So, dame e gospodo, dobar dan. Thank you very much again. It's wonderful to be back and see a lot of friends in person after more than 2 years. Also, a lot of Serbian friends around. I would like, first of all, to congratulate Svetislav for the excellent organization, for inviting us. Wonderful, beautiful city, beautiful people. Keep going this way. Thank you to Vikram and congratulations also to Mario, Andres, and all of you for setting up this great initiative and great conference. I think we are going to try to make this session as entertaining as a Netflix series discussing international corporate taxation challenges. So I would like to briefly introduce to you the people on the panel. So the gentleman here on my left-hand side, I don't think needs a lot of introduction for those of us international tax geeks, but still, Professor Wolfgang Schön, director of the Max Planck Institute. Thank you for co-chairing with me. It's really an honor. Then I have here my right-hand side, Professor Aitor Navarro, also from the Max Planck Institute, previously with the Carlos III University in Madrid. My friend PaoloArginelli, professor at the University Cattolica del Sacro Cuore in Italy. And then I have Professor Vikram Chand from the University of Lausanne. Also good to see you here. The two gentlemen down there, we have first Philipp Besson, partner at WTS Global, and old friends also from the OECD days, Stefaan the Baets, now senior counsel with PwC. Now, I'll stop here. I think these people have way more interesting things to say than myself. So I pass the word to Professor Schön. Thank you.
Yeah, thank you, Gianmarco. Also from my side, congratulations to the organizers. And as Gianmarco said, this might be streamed by Netflix. And if it is successful, there will be season after season of this conference coming up in over the years. That's for sure. Also, I hope that we are now connected with Professor Luis Eduardo Schoueri, who will join us from Sao Paulo. But I think he's not yet there, but we know that he tries to dial in. As regards the topic, I think this very closely is linked to what we have done and worked on so far. Yesterday it was about mobility of individuals in a very general sense. Today it was about the link between individual mobility and corporate mobility. So you have to take into account both the activity of corporate residents and the rising activity of residents and activity for people. But there's still a third dimension which makes the overall situation even more complicated. And that's the fact that you can divide your corporate entity into a large number of sub-entities. So we have large corporations which have entities as subsidiaries. Multinationals have up to hundreds or even thousands of those. And now imagine a world where employees travel around freely. Corporate residence of the parent company might be somehow fixed, but corporate residence and activities of the subsidiaries are not, while they are interlinked. And then you enter a world where shell companies, avoidance structures, but sometimes simple business necessities like limitation of liability or compliance with local business requirements and risk sharing or risk aversion come into play. This is the world we are now discussing in the next 2.25 hours. And I give the floor back to Gianmarco to kick off the first presentation.
Yes. So before now leaving the floor to Aitor, I think before joining Netflix, I also had the pleasure of spending some time with the Italian government during the BEPS time. And I remember that the discussion at the OECD around substance were very, very fierce. And also I remember Stefaan was there first in the representative as a representative of Belgium and then of the OECD. And I can tell you that for hours, days, months, the OECD tried, specifically in the context of the transfer pricing guidelines, at least to come up with a definition of substance, and they failed. In fact, if you want to play a game, don't do it now. When you will open your digital version of the transfer pricing guidelines, try to include the word substance and see how many times it's going to pop up. I think very, very randomly. Having said that, Professor Aitor, floor is yours, because I think he's going to discuss a lot what substance means post-BEPS in light of the fact that now we have mobility involved. So thank you.
Thank you. And of course, thank you to the organizers of the event, and especially Svetislav. Thank you for hosting us and um, promoting this type of initiatives for academics and practitioners and people in the tax world to gather and reflect critically on these matters. So as you all know, the BEPS project was very much, or one of the main points of the BEPS project was about substance understood as people performing functions in a way in which value is created. Somehow this sounds very vaporous, but at least what everybody seemed to agree is that entities without substance, without employees, without people performing functions should not be attributed the portion of profits that they were earning because of being the owners of assets, should not get access to beneficial tax regimes such as tax treaties, such as the European Union Parent Subsidiary Directive or the Interest and Royalties Directive. So at the end of the day, what the BEPS project entailed in this regard is to was to put the barriers of entry to all of these to the benefits of the international tax regime somehow higher. It is still possible to use conduit entities, but now it is somehow more expensive because instead of having to move contracts, one has to move people. Yeah. Actually, this was very well illustrated by former Professor Jens Wittendorf from Denmark, who said countries with mild and sunny climate will now be favored as tax haven locations over cold and rainy locations because people, rather than written contracts, must be relocated. And from this standpoint, what I asked myself, and the result is this presentation I'm sharing with you today, is whether this is indeed necessary in a world in which one can work from any location. So, simply put, the relevant question will be, may entities achieve substance through remote workers? May, for instance, an entity located in Singapore hire workers, hire employees that are located in the Philippines, and put these people to perform functions related to the activity in order to surpass all of these new standards created after BEPS. Yeah, for this entity to still get, or that this entity gets profits attributed, that the entity can access to treaty benefits, that the entity can enjoy all the benefits from the international tax regime. So this is the question I asked myself, and the way of addressing this question was to check whether the guidance produced by the OECD and other relevant actors said anything about this perspective, about whether remote workers could be or could suffice or could be enough in order to inject sufficient substance for entities to operate and, as I said, benefit from all of these regimes. To address this question properly and not end up in basically writing a book, I had to make some assumptions. For instance, I don't deal with the possibility that these remote workers generate a PE. And anyway, this topic has been discussed already in previous panels. So my assumption here, or to perform this analysis, is that there's no home office PE. Also, that no poem problems arise, because then the issue is completely different to what I would like to analyze here. And also, for this to be interesting enough, because if we approach the problem from a cost-benefit perspective, the idea I'm trying to analyze, or the notion I'm trying to analyze, is whether companies can keep the costs or of maintaining a certain tax structure as cheap as possible somehow. That the countries don't the regulations of the countries where the entities operate don't have high labor costs in the form of social security regulations or labor law regulations. And in this sense, and in order to start with the analysis, and this is the structure that I adopted, what I did in the beginning is to take a step back and understand, why is this actually a problem? Why are we discussing about it? And anyway, the previous panel did an excellent work illustrating this point. This is related to the fact that the current rules on international taxation are, frankly, inefficient. Inefficient from the perspective of the fact that they lack robustness, that taxation sometimes, and for certain players that have a certain size and operate internationally, can become certainly elective. Yeah. And somehow this is yet another symptom of this problem. Yeah. So I'm not about to provide solutions in this regard. Probably the solution is to move to a corporate tax that is based on immobile factors, but this is not existing nowadays. So what I'm trying to describe is what is happening today with what we have in terms of regulations, recommendations by international institutions, etc. Yeah. In this respect, the problem may be addressed from different perspectives. I chose these four that you see on the screen. The first two are very much interrelated. This is whether PE, profit attribution guidelines, and transfer pricing guidelines address the use of remote workers to perform functions so that the entity or the PE can retain profits. And I don't want to elaborate that much on the topic, because I think it is too complicated to address it seriously within the time limits we have here. But I will just mention a couple of ideas that are probably the most striking ones for you to get a flavor of the issue in this regard. If one checks the PE profit attribution guidelines issued by the OECD that were discussed in previous panels anyway, everything is about functions. This was said. Risks and assets follow functions, and the functions are performed by people. Yeah, this is not being challenged, of course. But what I wanted to mention is that if you check the guidance of the OECD, what you will not find is how to attribute the people to the permanent establishment. There's complete silence in this regard. And of course, if we are referring to remote workers, this is very problematic. Yeah, this can create issues on the fact that these remote workers probably don't even need a labor law agreement somehow in this sense. Yeah. And another big hurdle of the guidance in this respect, and this time this is a problem that is both related to PE profit attribution and also to transfer pricing, is the relevance of decision making. Yeah, decision making is a mantra nowadays in the OECD, especially after BEPS. even in the context of the PPT and even in the context of ATA 3, as I will show in a minute. But I don't think that the term has been addressed seriously in this regard, because at the end of the day, if this is about allocating profits to a certain jurisdiction, taking decision making as a reference is indeed an issue, because this is a mental process, and this is not a mental process of one person. This can be dispersed, this can be granular, and it happens very often in the context of multinational enterprises. Actually, we don't know what decision making is about. Is this the decision making referred to strategic decisions, operational decisions, implementation? What are we talking about? And again, as the issue here is the use of remote workers or remote personnel in the context of profit allocation, problems just continue to come, because in this context, because of the lack of guidance in these regards. Probably this is also understandable, because probably remote working was not a relevant phenomenon as it is nowadays, right? Great. Anyway, what I wanted to focus a little more on is on the PPT and ATA 3, because I guess that people are more familiar with those, especially with the PPT. Regarding the PPT, I'm not going to deal with the construction of the rule, all the criticism on it. I think almost everybody will agree that the PPT is a disaster from a dogmatic point of view, and very difficult to deal with. But there's a reference in the commentaries, of course. And what I did is to check the examples provided by the OECD to see if they dealt with, or whether substance in the first place, and in the second place, whether remote working was taken into account, right? And what I found is a very asymmetrical treatment, because in some examples, yes, substance is relevant. It is relevant to have people performing functions, and in others not. Yeah. One of the examples in which these aspects are relevant is this example K, in which simply a fund constitutes an entity in another state R there, for it to manage a portfolio of investments in the region, right? And here I just copied some statements of the example. It is said, so the example is constructed in a way in which it passes the test. So this is considered not abusive by the OECD, and it is, among other reasons, because there's an availability of directors with knowledge of the regional business practices and regulations. The entity employs an experienced local, and this is an important word in this context of remote working, local management team to review investment recommendations. The majority of states, of directors are resident in state R. Yeah. So the example is constructed in a way in which it seems that the location of directors and workers is relevant. And now more problems come to play. Is this necessary in the context of such a structure? Is it necessary that the people is really on the country, or will it be possible that they are located somewhere else, performing their functions through their computer and being located in another country, right? Is it this, in a different scenario, a marker of abuse? So the fact that this very same structure is constructed in a way the employees and the managers of entity are located in another jurisdiction and performing remote work, a pointer of abuse? We don't know. So actually, the let's say the development of the example doesn't reach that point. But anyway, what I would like to express is this sensation of asymmetry in the treatment. For instance, in the in other examples, such as example A or example B, which regard classical conduit structures in which the conduit is a bank, yeah, there the substance of the bank is completely irrelevant, because these structures are considered abusive, because the only purpose for these structures to exist will be to to benefit from the tax treaty, according to the OECD at least. And there no substance, so substance is not relevant at all, right? Yeah, so in this sense, of course, a lot of uncertainty is the result, as with many other aspects of the PPT anyway. But if we move forward and and we take as a reference ATA 3, and I will be very superficial because actually this is the specific topic of Paulo after me. I just wanted to remark the fact that this issue of the location of workers or directors is treated almost randomly in ATA 3. And here you have a good illustration, yeah? For those of you that are not familiar with ATA 3, I will just say that this consists of a series of tests to check whether an entity is a shell entity or an entity with substance. If the entity is a shell entity, then there are certain consequences in the form of reporting obligations, in the form of the denial of a residence certificate, or the most severe ones probably are those in which the entity cannot access to tax treaty benefits or to the benefits of EU directives. Yeah. And then when checking these criteria to define whether an entity is a shell entity or not, the first test, yeah, is referring to aspects that will allow remote workers to exist, yeah, and still achieve substance. So the specific criterion that will be relevant in this regard is the need not to outsource the administration of day-to-day operations and the decision-making on significant functions. Yeah? But it doesn't say anything about the location of the workers, the directors, etc. What is needed is that there's no outsource, but you can have your people in another country. That's completely fine. Yeah. Actually, here the issue is how to define outsourcing. But I'm not going to elaborate on that anyway. The carve-out rule. It says undertakings with at least 5 own full-time equivalent employees or members of staff exclusively carrying out the activities generating the relevant income. Again, location of these people is irrelevant. Yeah? Basically, if you have 5 guys performing functions, you are safe from ATA 3. Yeah? Which I don't think it is, I mean, a very appropriate test if what ATA 3 is dealing is with abuse, which, by the way, in my opinion, I think it is not. But that's another story, and or we will postpone these considerations for the next presentation. No. Then there's another test in which one really doesn't know whether remote working is possible or not, because the requirement will be that one or more directors or the majority of employees are resident for tax purposes in the member state of the undertaking. So the location of these people then is relevant. They have to be in the same state, or, and now it comes, at no greater distance from that member state insofar as such distance is compatible with the proper performance of their duties. Yeah. Here the problem comes because if these people just need a computer to perform them functions, they could be located in South Africa, right? I mean, and this will be a proper distance because anyway, as far as I know, even South Africa has the same time. Yeah, or we are in the same time zone. So, I mean, yeah, is this really what the European Commission wanted to achieve, or is this what they were referring to? But actually, there's a twist on it, because when an entity is considered a shell entity, there's the possibility of rebut such conclusion. And here, ATA 3 is requiring the entity to provide concrete evidence that decision making is taking place in the member state of the undertaking. Yeah. So here it is clearly relevant where these people performing functions, where the people taking decisions is located. Does this make sense? Is this coherent? Probably not. But I actually don't know whether the drafters took this perspective into account. Yeah. It seems it doesn't make that much sense that according to the first test, one can have remote workers and pass it and not being a shell. While in the last test available, yes, you have to have your workers in the member state of the residence of the entity. So again, the outcome is a lot of uncertainty, an asymmetric treatment of the issue, and probably overall a symptom of the lack of robustness of the international tax regime that probably can only be addressed from starting all over with other corporate tax, not based on immobile factors. But this is again right now science fiction, I would say, right? Thank you.
Aitor, thank you very much. I have 1,000 questions, but I will refrain from asking that now. Yeah. Paulo, floor is yours.
Okay. So if we were within the Netflix domain to tackle this issue, we would probably need the whole series. But time is limited. You're lucky, I'm lucky as well because I have to take a plane. So it will be just one single episode. And if we were in an episode of Netflix, we would need a subtitle because it's very long, and would be something like a tale of overregulation. It's just an episode because I've been asked to discuss this topic, but obviously the title does not say directly, but it has to be discussed in the light of the general topic of this Congress, which is mobility of individuals and workers. And that's what I will do. So originally I planned to have 3 parts in this presentation, one introducing 8.3 or the Unshell Entity Directive. I will do it. Second, dealing with mobility, strictly speaking. And third, that I will skip most probably, dealing with incoherence of the effects of the application of the rules. We'll just touch upon certain points. In a nutshell, we have to consider that this proposal has to be analyzed against what the Commission said in Communication 251 of 2021, which was a communication purported to set the framework for long and short-term initiatives dealing with a robust, efficient, and fair system of taxation of business within the EU. And that's what emerged also from the explanatory memorandum of the directive. The explanatory memorandum points towards the need to deal somehow with the issues of tax evasion and tax avoidance that might be created by the use of shell entities. Entities without minimal substance and economic activity. And in order to do so, the specific problem that the Commission singled out is that we need to somehow complement the domestic law of member states because they are too dissimilar from each other and they are not effective in dealing with shell entities. And in order to get at this objective, we need, on the one hand, to have a common approach, say common markers of abuse of substance, and on the other hand, to have also harmonized tax consequences. In the case where entities with no enough substance are found to exist in member state. And we are talking about entities that are tax resident, whatever the form they have, in at least one member state of the Union. The Commission also points out that it's extremely important to have this common approach, because common approach also means that we are going to reduce legal uncertainty and especially to reduce cost for tax administrations and for taxpayers. So keep it in the background, it's in the back of your mind for later. Now, this main goal is to be achieved by means of a 5-step plan, which start with entering into the domain of the directive, future directive, the gateway test. The gateway test is set out in Article 6. I just go briefly through this. There are 3 tests. The entity, in order to enter in the scope of application of the directive, must have more than 75% of its revenues substantially stemming from no activity or certain tainted activities, so passive income. It must be mainly dealing with cross-border activities. There are 2 specific tests to see whether cross-border activities are in place, and that's what Aitor was referring to. There is a 3rd test. It must outsource the administration of day-to-day operations and the decision-making on significant functions, whatever it might mean. If this gateway test is passed, then you have, in any case, a possibility to ask for the application of the subjective exclusion. That's Article 6, Paragraph 2. For instance, whether the entity has or not securities admitted to trading or listed in a stock exchange, regulated stock exchange, whether it is a regulated financial undertaking, or whether it is an entity with 5 or more full-time employees carrying on in the activity that creates this passive income. And there are a few others. If even it's not possible for you to ask for the application of the subjective exemption, then you go to Article 10, and you may ask for an exemption based on a no tax benefit test, which means that you can prove that the group as a whole or the beneficial owner, then you have an issue with the definition of beneficial owner because it refers to AMLA regulation and not to tax regulation. However, that no tax advantage derives from the setting up of the entity, not even a small tax advantage. If it doesn't apply, then you go into the reporting obligation in your tax return. And in the tax return, you also have to self-assess whether you are going to meet 3 indicators of substance. If you fail one of them, then you are presumed to be prima facie an abusive entity. Abusive because you don't have enough substance. Now, Article 7 lays down the 3 indicators. The first one, the entity must have premises in the member state of tax resident, not another member state. Second, it must have an active bank account in the Union. Nobody knows why. But let's assume it's relevant. For sure it's relevant to restrict free movement of capital with third countries. Not sure whether it's relevant to assess whether the entity is abusive or not. Bless you. And third, there is a test. I will go back to this test later. dealing with the qualification, effective activity carried out also. And finally, the tax residence of directors or of the employees. Now, if you get into this and you fail to rebut the presumption, because there is a possibility to rebut a presumption under Article 9, Aitor discussed briefly this, I will discuss also later, according to a business activity test, then certain effects kick in. And the effects are mainly two. On the one hand, the member state of the entity is not allowed to issue a tax certificate of residence for treaty purposes or for the purpose of application of the directive. Or it can do that, but it's a sort of tainted tax certificate, so saying that with a statement according to which the entity is not entitled to the tax benefit of treaties or directives. And then there are effects in the other EU member states that substantially boils down to treating the entity as a pass-through entity, so look-through approach, disregarding that entity for the purpose of the directives and the treaty. So as if from tax purposes was not existing. Now, what are the main deficiency of the proposal, according to me at least? And then I'm sure that will be discussion on this. And I imagine that the discussion will support my view, by the way. The deficiencies are, first, that proposal in agreement with the principle of subsidiarity and proportionality to issue directive under Article 115 of the Treaty on the Functioning of the EU. My answer would be no, it's not necessary. It's overregulation. It's a very good example of overregulation for students, and it's not proportionate. We are plentiful of anti-avoidance and anti-evasion tools after the BEPS era. We have GARs everywhere. Every time you open a closet, you have a GAR. You have GAR under Article 6 of the ATAD. We have SARs like CFC legislation. You have anti-avoidance rules in the directives. You have the PPT in the treaties. You have, if don't yet implemented the PPT, you have the well-known or not well-known guiding principle under commentary on Article 1 of the OECD model. And we have exchange of information. Our tax authorities are capable of gathering information to assess whether there is an abuse or not. We also have automatic exchange of information that might be relevant in this respect, DAC 2 and DAC 6, for instance. Other alternatives? Well, there are at least two alternatives. One is simply throw away the proposal. And second, if you really want to do something, you can have a DAC 12 by means of which you automatically exchange of information of certain markers of possible existence of an entity without substance. Now, I cannot move probably any longer because the time is expiring. So I ask help to the gentleman at the back, because slides are not moving. Now they're moving back. Okay. It's ambiguous in defining the targeted evasion and avoidance. It's not clear. Aitor already said it before. It's not clear exactly what we want to tackle, because certain of the provision seem to point to tackling wholly artificial entities. So entities really without any kind of minimum substance and activity. Is good or not is outside the scope of this presentation, but that seems to be the target. But there are others, and Aitor already pointed to some of them, I will do later on, that seems to look at entities that are or might be with substance, simply have the substance in the wrong place according to the Commission, which is not in the member state of tax residence, somewhere else. Some of the provision even seem to look more at the issue of appropriate allocation of income for corporate tax purposes, which is completely different type of issue. And then the effects are incoherent with the objectives. Because if we think that one of the objectives is to target abuse of tax residence, I set up a company in a certain jurisdiction to benefit from tax treaties or to the directive, but actually that company, which has enough substance, has carried out as activity from another state, another member state, or a third country, then you shouldn't look at a way of avoiding abuse by means of disregarding that entity or having a look-through approach. That's not proportionate. The problem is that you're applying the wrong treaty or you're applying the directive when you're not entitled. But you should apply the treaty with a assumed place of real tax resident, if this concept has any sense. I think probably some colleagues like Andres would say it has no sense, but even assuming that there is an ideal place of tax residence, you should apply then the treaty with that country, not simply disregarding the entity. And by the way, there is no definition of shell entity. So it's not a regulation based on principle. And this subsequent series of tests, exclusions, test, exemption, obviously create legal uncertainty. On top of it, just to be sure that we have the mouth full of rules to counter tax avoidance, there are two specific parts of the preamble, which are recitals 3 and 9, where the Commission said that even in the event when you consider that under the directive the entity has substance, then member state may apply their specific anti-avoidance rules to counteract the possibility that it could be regarded as a shell entity, which clearly goes against the purpose of having legal certainty on the one hand, simply create an overlayer of regulation, and on the other hand, it becomes useless, because if the proposal were effective and were proportionate, you wouldn't need any longer the application of domestic tax rules to deal with the very same subject matter. And finally, mobility. How does it impact on mobility? What's the interaction? I just not go to Article 7. Aitor already discussed that, and is not the article where you find a clear friction with mobility. Article 7 does it much, much better. Substance indicators, 7.1a. We read it already. The premises must be in the member state of tax residence. That's clearly going to target entities that work from remote, either from other states, perhaps other member states, or where the people are teleworking. 7.1c, which is the one concerning directors and employees. I will just read a small part of it. You find in the slides in my back. One or more directors or the majority of the full-time equivalent employees. Not clear why it's just one director and the majority of the employees, and not the majority of the director and one employee, but it's fine. A resident for tax purposes in the member state at no greater distance from the member state, insofar as such distance is compatible with the proper performance of their duties. We saw it before. Now, this is the rule, and these are the issues. Obviously, also this one targets entities that are run from other states. So, an issue with mobility and teleworking. And second, it has been said this morning in a very clear manner that tax resident of individuals is today anchored in many countries to just formal connecting factors. So it's also a rule which is ineffective because it's very easy to get the tax resident of the director under the law of many states, if this is the target.
Paolo,
Yes.
5 minuti.
Okay, thanks, Giammarco. In my watch, I have 3 and 10 seconds, so I have 1 minute more. 2. There is an issue also with the other side of the coin, because substantially this is a rule that does not consider there are certain cases where the people have substantive activity carried out in a certain country without taking up the residence of that country, which is also an issue that you might solve by application of the of Article 9, we will see later on, but it's not always the case. And then there is the issue of the distance, insofar as such distance is compatible with the proper performance of their duties. And here there is an interpretative issue that I already highlighted. You have 2 ways to interpret this. Either you give a central relevance to the fact that what is important is that you must be able to carry out properly your duties. And then, well, for duties that can be carried out from remote, then this test is meaningless. And that means that the proposal is targeting wholly artificial entities. But there is the other way of interpreting the provision, which is the one that find also support in the explanatory memorandum, which is the one according to which what is central is the distance, because it is assumed the activity must be carried out in the state of residence of the entity, which means that you're not targeting wholly artificial entities as such. You're also targeting entities that have substance, but in the wrong place. Finally, a few words about the rebuttal of the presumption. Article 9. Well, the rebuttal of the presumption has an inherent lack of conformity with the principle of prohibition of abuse under EU law. There is no objective test. There is no real relevance given to motives. Yes, there is a reference to the rationale of the setting up of the company under one of the indicators, but then is completely disregarded by the rule that tells you what you have really to prove in order to rebut the presumption of being abusive. And Article 9 to C makes specific reference to the fact that the decision making must be at the place of tax resident of the enterprise, once again, not in other countries. 9.3, which should be theoretically the relevant rules that tells you how to rebut the presumption, says, well, the rebuttal depends on whether you prove or not that the undertaking has performed and continuously had the control over and borne the risk of the business activity that generated the relevant income, which is clearly terminology that does not have much to do with substance as such, but more substance, which is term not used for TP rules or allocation of profits rules. And this is obviously inconsistent with 9.2c, as obviously not focusing on a cross-border dimension, but then you have to ask yourself, do I have to interpret it in the light of 9.2c? And the answer seems to be yes, and therefore we have a problem with mobility. So although it appears to have no connection with cross-border situation, when you read in the context of the proposal, it does have, or it could have. Now, my presentation would be over because I'm not going to present this as homework for you, simplified homework. So you can go through it and see that the effects are inconsistent. Last word, because I did not forget to thank, obviously, the organizers. So I would like to thank the organizer, or better, I would not like to thank the organizer for inviting me, and not even for hosting me these days during the conference that too many people said is clear-cut. I would like to thank the four organizers, the four knights, for a different reason. Because I think that the setting up of this international tax law research and policy network, I wrote the full name here because it's too long, I don't remember. I think it was the most brilliant and exciting things that have been seen in the domain of international taxation in the last 15 years. Much more exciting than the BEPS project. It was not difficult, but you really did a great job. Thank you.
Thank you, Paulo, for your presentation, your uncontroversial words that will make the OECD and the inclusive framework happy. But I completely agree. Fantastic initiative and great presentation by both of you. So before I start triggering a little bit the debate, I would like, first of all, to hear what our fellow panelists have, if they want to comment. Philipp, Stefaan, if you want to go ahead first, and then we will open the floor to the audience. And
Yeah.
Eduardo as well, that is connected now. Vikram is coming later. Vikram, we did not forget Vikram. We did not forget Vikram at all.
Okay, no, thanks, and indeed, Borislav, thanks for having me here. It's been great so far. So, and I think as we continue to, it will be even greater. So thank you very much. My 2 cents may, or very likely, may not be the views of PwC. Of course, I'm speaking here my personal capacity, and let me start, and thank you, Aitor and Paulo, for this presentation. And let me start perhaps with 8.3. And what I think is there's a principle of being innocent. But what 8.3 seems to do is to turn around that principle. Guilty until proven innocent. That's actually the opposite. So you have to prove you are okay, which is weird. But if you can see, at least in my opinion, we see here a very aggressive European Union Commission. Not only a very aggressive European Commission, but also a negative European Commission vis-à-vis multinational enterprises. If you look at all the transparency rules, all the rules that have come out for the last couple of years, we can think about DAC 6, we can think about DAC 7, we can think about DAC 8, we can think about DAC 9, 10, 11, 12, 15, 20, whatever. We can think about DEBRA, we have the 8.3, we have the principal purpose test under 8. We have all these elements really targeting multinational enterprises. I wonder whether they actually have already visited a multinational enterprise, because not two multinationals are the same. I think they should first look and see how is a multinational enterprise organized and how do they perform their functions, assets, risk, how do they do it? They talk about 5 people in the 8.3, they talk about 5 people. For certain elements, you don't need 5 people. Think about a holding company, which has substance. You don't need 5 people to run a holding company. This is precisely where they go wrong. They should have an impact there. So I think we kind of are aligned there on that position. Thank you, Paulo. And streaming it then back to what Aitor has been saying, let me start there by saying that transfer pricing, and I'm a humble transfer pricing specialist, a humble allocation specialist, but still transfer pricing and allocation of profits, it's not the same thing. It's not yet the same thing. There are overlaps, that's for sure. It's similar, but it's not the same. Because a permanent establishment is not a subsidiary. It's simply not the same. Hence, for example, the creditworthiness. Creditworthiness of a permanent establishment is the same as the head office. It's not the same thing. So there are differences. There are differences. And linking it then back to mobility of workers, assume that you have working from anywhere, that you have a permanent establishment for that worker. The same creditworthiness? Indeed, I think we must revisit perhaps the system, perhaps re-emphasize the authorized OECD approach, make it much more simpler. Can you already imagine applying step number 1 to someone who is working from anywhere? With the 5 steps? I mean, also we saw earlier this morning, we saw on the slides, yeah, cost plus profit split. Easy enough, fair enough. That's not the hard. Exercise in allocation of profit. In a permanent establishment environment, the difficulty is hypothesizing the permanent establishment as an independent and separate entity. So, with regard to BEPS, we also heard criticisms about BEPS. Guilty as charged. In my former life, I was part of the BEPS project. Yeah, guilty as charged indeed, and not presumed innocent. But what we have there is value creation. At least they try to do it as I would say, a proxy for substance, or vice versa. Has it been successful? Well, if we look here at the discussions we have, very likely not, because indeed, what is that substance? Again, I refer to my earlier comment. Go and look into the multinational enterprise. Go and look into subsidiaries and the branches, and then you will see whether there indeed is substance or not. How is that value creation then actually done? With regard to the remote working, locational advantages, this might pop up again. And this might very well pop up again. If we look, for example, at countries like China, they had already years ago, when the 2017, when the BEPS reports, the 2017 transfer pricing guidelines were drafted, when the BEPS reports were drafted, there was already this discussion, for example, with China on these locational advantages. So this working from anywhere thing, this working from home, this will even be more on the forefront than before, actually. Let me end by referring also to cash boxes and risk-free returns. And this morning also we had the example about the windmills. And the thing there is, well, okay, intangibles are highly mobile. Workforce, they're a bit more resident, so a bit more stable, but also we see they're highly mobile. And indeed, you have the nomads, you have the digital nomads. It's coming on now. But what we see here is that it may also be because of the transfer pricing guidelines. That is that we have a huge emphasis on risk taking, control over risk. There are three elements in the transfer pricing guidelines to determine who controls the risk. Does that mean that, for example, that those windmills, that it's not a permanent establishment, that there is nothing going on? I think there's a lot of things going on, but perhaps there has been too much emphasis now on the risk-taking by persons. So perhaps, and I know in the 2010 guidelines, the control over risk framework was not, I would say, not defined enough. There was too little guidance. But that pendulum has completely swapped to the other side, where there is now perhaps an overemphasis on risk, perhaps not enough now on functions, and perhaps not enough on assets. With that, I close my 2 cents.
Thank you very much, Stefaan. Philipp?
Thank you. Also, I'm really want to thank you for this great presentation. I'm completely in line with you and also with your comments. I would like briefly say something. So 10 years ago, I was involved in a preparation of a directive, and a commissioner told me doing nothing is no option. What happened? Nothing. And it's really perfect that now at the moment here there is an intellectual discussion which hopefully gives ideas to the OECD but also to the local levels for coming up with proposals. We heard yesterday on the individual taxation side that it's burning there, but also this topic I think is very, very important. And I prepared myself, and I work in a tax advisory firm, so I advise clients in their day-to-day business. And then I said, okay, how to prepare? So I said, okay, I asked some of my major clients, what do you think about post-BEPS and mobility? And some brief comments. So I talked with the head of tax of a German DAX company, and she told me, costs. That is just spent. I said, what spent? Yeah, the spend for advisory companies, the spend, internal spend. And I said, and taxes? maybe VAT for the flights, for the carbon we have to spend to compensate these kind of things. So she said, it works, but I'm really angry. We are punished with very complex rules, and there's no outcome. We are prepared, so no more money, no fundraising. I talked to an head of tax of a US software company, and he told me, yeah, should I take that serious or not? We will wait and see, but anyway, we are prepared. The mobility topic. I talked also with both of them about mobility. The US guy said to me, mobility for me is no topic. We have all over subsidiaries and we have branches, so we work in matrix organizations. We can manage that. Okay. The head of tax I started with, she told me it's a little bit more problematical because it's a financial service firm. We work with capital. We work with money. 5 people, as we heard. Why 5 people if I have 2 times a year a decision? Why that? So then I said, okay. Then I talked with the head of our international tax practice of WTS, and he told me, mobility at the moment, it's for me in the advisory no topic. But I said, but do you agree that in this global world that we should get rid of this elements like 5 people, directors, and you need to be on site? He said, yes, let's get rid of them. But what then? Are the other components sufficient to compensate? And he said, the most important thing for me in the daily advisory for our clients is legal certainty. And we advise usually the clients to have a legal certainty to work and to avoid or to mitigate problems in the future. So he said, yes, but please, if you abolish that criteria, find another criteria. But don't go for that complicated and complex criteria, which are at the moment on the desks, and we have to read. And he said to me, capital is a shy deer. That's a German saying translated. I hope you understand it. And it's always one step ahead. If it sees there is a danger, then it moves ahead. And I don't think, he said, and I really agree with that these complex structures we are at the moment setting up will work in the future and will be efficient and will come to the target which is intended. He said to me, and I share that opinion completely, that what was efficient in the last year, that was the reputation topic. Plenty of companies changed their mindset, and he said, and changed also the structure just to avoid that any reputational topic could be brought up and discussed, because that's the real risks for companies being in direct contact with the client. And that was much more efficient than any of these tax guidelines and rules which are at the moment on the paper. Then a second comment, if I have 2 minutes more, yeah. So what do we need is simple things. And that would also my wish to you as lecturer, as intellectual group thinking on taxes. If you go forward developing new criteria, think simple. Please think that a normal taxpayer without an advisor should be able to judge the rules and to judge the law and to find solutions. Yes, advisors like to earn money, that's okay, but that should be our goal. And for me, and also this is something which also this morning was highlighted, we talk about corporate income tax. Corporate income tax in Central Europe is about 10% or less of the total revenue. So a whole community spends thousands of hours, a lot of money, in investing in strategies to raise the revenue, to avoid hiding money, avoid taxes. But is this really the right approach? It's just a question, yeah. So why not thinking on tax at the end of the chain, consumer, just also maybe, I know that is not very popular, maybe also tax substance, because we always look for justice in taxation, but does it exist? It depends on your view. And also each tax administration has another view on what is okay and what is not okay. If you look on a developed country, on a sexy country with seaside, with sun, or you look on a country without seaside, without mountains, and with rain. And so that's the thing I just wanted to add. That's it at the moment. Thank you for that.
Thank you very much. We have our esteemed Luis from Brazil. Bom dia. Can you hear us? Yes, please, Luis.
Comparison of substance in different. Aitor, it was clear that you showed some blanks, some solutions which were not achieved in one or the other area. But what I would ask you is whether the comparison is permitted. I mean, I felt that your paper missed this very first question, which is there only one kind of substance? Should there be? And this is a principle-based question. I mean, each of these environments different objectives, and for that reason, maybe the concept of substance in one or the other does not need to be the same. Or yes, but I mean, you didn't. I felt that your paper should begin by showing why the comparison is possible. Of course, because there is only one international tax regime, which I don't believe. Even if there were, I mean, in one legal system, the same expression may be employed differently depending on the objective of the law itself. So the issue of objectives should be better covered. And when you compare your paper to Paolo's presentation, Paolo was very clear when he said that APA has no principle. And this is a very strong wording Paulo is using. And you know, I'm not European because I don't believe Paulo Acker has no principle, not principle based. But this brings more difficulty when I say, well, if there is no principle, or if it's not principle based, then the comparison is even more difficult. I mean, your exercise, actually, word by word, showing that something is missing here and not there, especially when you talk to remote work. It's a nice word, but it doesn't bring me to the conclusion that the loophole could be covered somehow, getting some wording or some solution in one system to the other. And I read your paper and I could not reach, as I go into allow me, I could not find the conclusion. Can you or not fulfill the loophole of one bound with something of which is the other? The fact that some word is missing in one and not in the other, whether this means that the was on purpose or not. I mean, enjoy reading the comparison. Enjoy it. But illusion on it becomes this base. So I would ask you, uh, is there one international tax regime? Can you compare these different environments and just say, well, there's substance here, substance there, so I can get conclusions from one to the other, either fulfilling the loopholes or just pointing that there was a reason for the loophole. I missed this, but going to Paulo, or I said I'm not European, so I learned a lot. This data. Paulo, please get me somebody who's coming from another environment. And certainly I read this issue which you presented for the gateways, which you refer to facts which occurred 2 years previously. I'd like to learn from you to tell me whether there is any issue on retrospectivity, which means facts which occurred 2 years in the past are going to be decisive for today's decision. I mean, a taxpayer cannot say, well, from now on, I'll have the substance, from now on, I'll fulfill the rules, because it seems that the taxpayer pays for the past. Is there any retrospectivity issue on this? That's what I will ask you, but when I read your paper, it came to me and I'd like to learn from you. I read also in your paper that even if you fail on the gateways and the substance, that you will rebut the condition of shell company by demonstrating that you have substance. But this brings some criticability issue here, how to make this demonstration. I mean, at the end, you're going to solve with functions, risks, and sets. It doesn't seem to be effective to make all this way on the gateway to get again on the solution. What's your opinion on this, Eduardo, Paulo? These were my impressions by reading the paper. I hope I could contribute. Thank you for the invitation to be here.
Thank you, Professor Schoueri. Wolfgang, do you have any response to that?
Yeah, I have some responses, but I think we have about 17 minutes for those two topics now before we move on to Vikram. So I would like to give the opportunity to Aitor and Paolo to respond 1 minute to Luis Eduardo's questions, and then we have another 15 minutes for the audience. Aitor, and be quick.
Yeah. Thank you, Luis. What I should say is that, and this comes from my discussions with Andres, he always tells me the only substance I know is the substance of the stew. So indeed, there's not a single concept of substance, and then the aim of the paper was clearly not to come up with a single concept of substance. This is why I didn't take the effort to pursue a name in which I don't believe at all. But what I see is certain convergence, on the standards that the OECD is using in different scenarios, with the reference to decision making, with the reference to people functions, and so on. And actually, my point was to make very clear that the topic of remote working in all this framework has not been dealt with in a serious manner. And I just point towards the issue. I don't provide any solution, and this was not my intention. So I just wanted to state that perhaps this is an issue that policymakers want to deal with seriously. Yeah.
They should. Paolo.
Well, Eduardo, it's very nice to see you, although from remote. So it's remote working. First question, retrospective application. I think you use the right term, retrospective, not retroactive. Technically speaking, the answer is yes, there is an issue. And then next time that we have more time, we can deal with that, but it's clearly a retrospective effect, and clearly it might be considered not proportionate and going beyond what we should have according to the principle of legal certainty. With regard to the rebuttal, rebuttal is badly worded because it's a circular test for rebutting something that you have already proved to a large extent before. It doesn't take into account seriously any commercial reason to setting up the entity. And even most importantly, it does not ask itself what is the object and purpose of the provisions of law that are going to be abused by the setting up of the entity. And then we go back to what was discussed, for example, in the domain of individual taxation this morning, residence. Do we really have a circumvention of the object and purpose of Article 4, for instance, of double taxation treaties, or the requirement of residence under the directive? I think no. And in any case, that's not the structure that a rebuttal test should have within this directive. The directive is not curable. You have to start from the outset if you want to do something again that is workable. And I don't think that we need. We need just to work with the rules that we have so we understand that they work or not in 10 years or so. Not now.
Thank you, Paulo. And now on the floor, Andres Baets. Is there a microphone available for him? It's always good, and so that Luis can understand it as well. Okay.
Thank you. Thank you. First, congratulations. I like two presentations a lot. Second, just a disclaimer, the thing on the stew is not mine. This is from my father from the point of view of philosophy of language. So let's see how cross-fertilization works. I mean, from one science to the other. And now going to the point. My first question on this goes essentially to Aitor. Why should substance matter at all for the purposes of the PPT? I go through the article, through Article 29.9, and I can see it. Of course, you can try and induce that from the object and purpose test. I don't want to call it objective prong because I know that Professor Schön had some problems with the subjective and objective way of naming the two tests that are contained there. So let's say the object and purpose. But as I said this morning, and I repeat this here for companies, I cannot see it. I can just see a reference to the object and purpose of the provision. I would agree with the fact that substance might be relevant for the PPT after having answered another question that still remains unanswered. And it's whether Article 4.1 incorporates a substantial link between a taxpayer, call it corporate, call it individual, and the territory, which I think it doesn't. And by the way, I said also this morning, it didn't before BEPS, and it does even less after BEPS. So I think we should first answer the first question, and then in case we answered that in the affirmative, then go to the second. And regarding, I'm sorry to be answering something that Luis Schoueri questioned to the writers, but I was thinking intensively on that. I will not talk about transfer pricing on attribution of profits to PEs. I made myself the promise many years ago that I will try to be away from all these topics. Perhaps I will not be able, but let's see what happens. But I see that in case, but that's of course in case substance might be relevant for the PPT, maybe we can set some parallels between the rationale under ATAT 3 and the PPT. Because in the end, what we are trying to tackle theoretically with these two rules, let's call them rules, there are sets of rules, actually ATAT is set of rules, it's not a rule, are the same problems. And the consequences in the end from not going through the test and saying that something is abusive might be identical or very similar. So even if I am a detractor of the very concept of substance, which I think is a clear misguiding principle because it assumes that substance might be defined univocally for every kind of company, for every kind of activity. And Professor Schön said that many years ago, you cannot convert this into a discussion of number of secretaries and fax machines, said Professor Schön. So imagine how many years ago this was. We were still talking about fax machines, but the discussion was still the same. Well, even if I think this is an end discussion, so there is no way on discussing on this seriously. In case it were, I think the discussion should be the same at the level of ATA 3 on the PPT.
Thank you. More remarks? Anna Paula.
Thank you. Very nice presentations. I would have a short remark on the free movement of capital issue that was raised. If it's related to this active EU bank account, it would fall under free movement of services following the Fidium Finance case. So,
Yeah, very
Mario, Tenora.
Yeah, very quick question, which is to you both at the end. As a practitioner, when I read, for example, the commentary and the example of the commentary that you quoted, I think also on the substance test, there is a lot of confusion because here the commentary refers to activities which we may consider significant, like approving and monitoring investments. But beside that, it also mentions activities such as treasury activities, maintaining books and records, ensuring compliance and regulatory requirements in states where the fund invests. So I'm a bit confused from what's your view on the scope of the activities which should indeed be the proof of substance.
And maybe if you allow me to, it's a compliment to your comments here. That's the remark. First of all, congratulations to both of you because you tackled the most difficult and yet unanswered topic. You tried at least. I think we need to do a little bit of a history check here. And I agree that we should try to keep transfer pricing away from this discussion, specifically in your paper and during your presentation, you refer on the concept of relevance of decision making to try to determine a kind of a proxy for substance. But when the OECD, specifically during the BEPS project, were redrafting chapter 1, they were not redrafting or try to come up with a definition of substance for purpose of anti-avoidance. The answer was focusing instead to determine the accurate delineation of the transaction for purpose of the functional analysis. So in my opinion, what I learned from both of your presentations is that there is a clear distinction that unfortunately there is a little bit, because of this confusing legislative hypertrophic production, a little bit blurred, that is, substance in transfer pricing is something that should be dealing with allocation of income, whereas in the ADA trade or unshelled directive is something that deals with anti-avoidance. So the fact that now instead and I think I try to find myself an answer why this is happening, because I think the devil is in on this word, value creation, that, and I completely agree with Wolfgang, with Professor Schön's position here, value creation is a term that has been used by politicians to find a label for action 8, 9, and 10. But if you take the current framework of the international tax system, there is no definition of value creation. You have two principles, principle of residence and principle of source. Where value creation stands, it should be a little bit in between, but why are you trying to use substance? So the question, and I don't have an answer, so I hope that one day the academics will come to this.
Yeah,
What is the outcome? What is the reason why we're having substance?
May I just follow up on what Gianmarco said, because he asked me to give some responses as well. I think, Gianmarco, when you point to the BEPS project, this is absolutely where the whole problem comes from. And the story runs as follows. In the old times, which I still remember, there were rules on the allocation of profits and the allocation of sources, and Article 7 and 10 and 11 and 12 and you name it, etc., and the PE concept and the transfer pricing stuff. And anti-abuse thing was not related to that. And the idea of economic substance was not related to that. And then came BEPS, and they wanted to reformulate the international tax system, but they didn't dare to tell us. So the political compromise, which you find in the BEPS documents in the action plan of 2013, is let's do something against tax avoidance, aggressive tax planning, etc. Let's do that by enforcing principles which, in my view, never existed in that fashion, namely taxation according to value creation and taxation according to economic activity. And let's do that by going through different elements of the international tax system, in particular the treaty system, which means that OECD at that point deliberately confused the notion of anti-avoidance and aggressive tax planning with further reaching elements of profit allocation and transfer pricing in order to change the system without naming it. And that's where it all comes from. Then they went into transfer pricing and said, we need people function, and we need DEMPI, and we need material, and. And they went into the PE concept around about artificial avoidance. You see, this is so telling. They didn't say we want to change the PE concept, because that would have been against the original statement, we will not change the rules. Therefore, they make rules against artificial avoidance of PEs, but what they do, they expand the concept of PE. And by doing that throughout allocation rules, definitional rules, transfer pricing rules, you name it, they created a fundamental confusion about where regular rules end, what is a PE, where is profit, and anti-abuse, which relates to intention, artificiality, contrivance, etc., ends. And then you end up, and Louis asked that question, with a situation where you simply cannot distinguish anymore between substance requirements being part of simple regular application of treaty law and application of anti-abuse law. And when you look at, let's say, a notion like economic activity, which comes from the BEPS reports, it is so clear that economic activity in the regular sense is much broader than economic activity when viewed as an anti-abuse test. These are different things. But it was deliberately confused, and it brought us into exactly the same situation where we are now. And I think both Aitor and Paulo have, again, 1 minute.
Thank you. I totally agree. Actually, this is taking concepts referred to profit allocation, which is a gradual thing, to the anti-abuse sphere, which is answering a yes or no question. Is there abuse? Yes. Is there abuse? No. And I will say this is the fundamental problem, right? On substance and the PPT, so in my personal opinion, the PPT, so from a dogmatic point of view, the fact that they refer to the purpose of each specific the purpose of each provision, this will lead the PPT not to be applicable to any case, because there's no clear specific provision of the allocation rules apart from allocating taxing rates. So you will get always the same answer. What is the purpose of Article 7? Allocating taxing rights for business profits in accordance with the content of the article. So it will be completely useless. I think this is the reason why the OECD went to all of these substance stuff from the perspective of the commentaries and the examples. And I hate having to interpret the examples in the commentaries. Actually, I wrote a paper saying that the OECD commentary should not have any privilege value at all in the interpretation process. But still, this is something to hold on due to the lack of other references. I will say this is my justification for the approach. Yeah.
Okay, Paulo, 1 minute.
I think the starting point from a DAX 3 and ATAX 3 perspective is what's the purpose? The purpose is to tackle tax avoidance and evasion, if we take it literally from it. And I think it is true in that regard that you might have a relevance of substance for the purpose of tax residence. I'm not saying that is right or wrong, but it's what also the Commission is trying to tackle. And the problem then is that since it's an anti-avoidance tool, you should understand whether under Article 4 or similar connecting factor, you have an object and purpose of ensuring that tax treaty protection or directive protection only occurs when you have minimum substance in the state of residence. And the answer for me now is no. But if you want to change something, you can change it. With free movement of capital, when I prepare for this, I look into Fidium Finance to see if that bad decision was applicable in this case. And I don't think it's directly applicable because that was looking at the provider of the services. You're looking at the entity set up in the union that decide just to put the money for holding companies, not really a lot of movement outside the union and or within the union. It's clearly not proportionate type of approach. But that's my opinion.
Thank you. So we are exactly on time, and we have now 45 minutes to listen to Vikram to discuss his findings. And I can tell you it will get even more complicated. So for anyone who isn't intellectually challenged sufficiently at this point in time, listen to Vikram.
Okay, thank you, Professor Schön, for that nice introduction. I'd just like to build on to what the gentleman from WTS, Mr. Besson, said, Dr. Besson just mentioned. He said the rules should be simple, clear, legal certainty. And I would just like to tell you, welcome to the world of Pillar 2 right now, which I'm going to discuss with everyone. And I'm going to talk about this. So let me just start off by telling you that under the current international tax system, multinational enterprises are exposed towards domestic corporate income tax rules, they're exposed towards tax treaty rules, transfer pricing rules, and EU tax rules when you're dealing with a European multinational. So that's the existing international corporate tax system that a multinational enterprise is exposed towards. Now, Pillar 2 and Pillar 1 are new systems, and they're actually built on the existing system. So you have the existing system here, which all multinational enterprises have to adhere to, and on top of that, you have the Pillar 2 and the Pillar 1 system. Now, what happens here is that this Pillar 2 and Pillar 1 system, they are not independent systems. They are highly interlinked to the existing system. So you have the existing system and then you have the new system. And whatever changes you make in the existing system, that is in your tax treaties, transfer pricing, EU tax law front, they have spillover effects on the determinations that are being made in the Pillar 2 and the Pillar 1 system. So what I will try to do in the next 15 to 20 minutes or so is that I would just like to show to you when you make changes to your existing system, and I'll try to demonstrate this by transfer pricing rules, which are actually linked to mobility of individuals. So my presentation actually builds upon the presentation that was done before by Stefan Gazzo and Svetlana Buriak and the panel discussion that took place in session 5. I build on that and I add to see what are the mobility related issues which can be analyzed from a transfer. So the transfer pricing issues linked to mobility, which can actually have an impact on these new two systems. Just as a caveat, I will not actually analyze the impact of remote working or new forms of working arrangement on calculating something known as the substance-based income inclusion, which you find in a Pillar 2 context. I'm just getting a bit technical here, as well as return on depreciation and payroll, which you find in a Pillar 1 context. I'm just not going to talk about that. So let me start with the globe rules as such. What is Pillar 2 all about? So the Pillar 2 rules essentially say if the effective tax rate of a multinational in a particular jurisdiction is less than 15%, then a top-up tax is applicable. So if a multinational enterprise is operating in a country which has a corporate income tax rate of 10%, then this multinational is exposed to a 5% top-up tax. Now, this top-up tax could be collected by the country of source, the same jurisdiction in which the multinational enterprise has a low rate through something known as a qualified domestic minimum top-up tax. So the top-up tax could be paid to the same country, or it could be collected by the country of the ultimate parent through something known as an income inclusion rule, or even complicated, it can be collected by the rest of the world in which the multinational enterprises through something known as the under-tax payment rule or under-tax profit rule. But the so in terms of the sequence, in terms of the rule order, you have the QDMTTs first, domestic minimum taxes, then the income inclusion rule, and finally the under-tax profit rule. Now, what I just want to mention to you is that these QDMTTs, qualified domestic minimum taxes, they are on the rise. Now, if you look into what's happening in a lot of countries such as Switzerland, Singapore, Mauritius, Hong Kong, UK, Ireland, Malaysia, New Zealand, Canada, Korea, Jersey, EU, Australia, all these countries, they're planning to introduce qualified domestic minimum top-up taxes. This basically means that if these taxes apply, then probably there are no top-up taxes under the income inclusion rule or the under-tax profit rule. So you have one set of countries, which I just mentioned, which is moving in one direction, more compliant with the OECD rules. But you have another big country, and we have a lot of representatives from this country, the United States, today, which has completely moved in another direction altogether. And there they have, in the US, they've introduced something known as a book minimum tax. And this book minimum tax has little similarities with the Pillar 2 rules, but it's completely different. So there you go. That's actually one set of complexity which you already see in the globe rules. Now, the key question here, before we get into the mobility stuff, is how do transfer pricing rules actually interact with the globe rules? Now, like I mentioned to you, the globe rules revolve around a formula, which is the effective tax rate. So the question is, how do you know if in a particular jurisdiction your effective tax rate is 15% or not? And for that, there's a formula. It's very simple. It's covered taxes linked to a jurisdiction by your globe income. Transfer pricing rules can actually have an interaction with both the numerator here as well as the denominator. The denominator is what I'm going to focus on. Let's just forget about the numerator. Let's just stick to the denominator. How do you go about determining the globe income? So just to give an example, so if your taxes paid in a country is 10 and your globe income is 100, then basically your effective tax rate is 10%. But the question now is, how do we calculate this globe income? So to calculate this globe income, the starting point is your financial statements of a company. So if a German parent has a Swiss company, the starting point to calculate the globe income of the Swiss company to determine the effective tax rate of the Swiss company is you start with the financial statements. Now, and you stick with the financial statements, not what you find in taxable statements, not what you find in taxable income purposes, but the financial statements. That's the starting point. Now, when you start with the financial statements, and then you have to make certain adjustments. And one of the adjustments that is authorized by the globe rules is that you can adjust for the arm's length principle. So this you can find in the globe rules in Article 323, which basically talks about adjusting financial statement figures with figures that you find in place for taxable income purposes. But this adjustment is not authorized in all situations, but only in a limited number of situations. It's authorized in a lot of situations. Some situations are not allowed, which I'll try to explain with an example here. So just to take a very simple example, practical example of a multinational group, and here I will try to illustrate these examples with the help of mobility. So let's take this example where you have company R, which is the ultimate parent entity of the multinational group, and it owns a subsidiary which is in another country, in country S. The effective tax rate of the subsidiary is, let's say, or the corporate income tax rate in the subsidiary is 9%. So Hungary is 9%. So there you go. So right now Hungary is 9% as an example. And let's assume the corporate income tax rate in country R is 20%. So in this example, of course, the tax rate in country S is below 15%. So you will have to do these top-up tax calculations. Now let's just say that we have a situation here where you have some kind of secondment of employees from company S to company R in country R. And these employees basically make available some kind of valuable know-how and trade secrets to company R. Uh, these trade secrets or know-how, they're not really protected in country S. So they're just trade secrets and know-hows in the hands of some selected employees. And then they make available this technology, this know-how, trade secrets to company R for local production in country R. And this IP can be exploited in country R. And basically, in these kind of situations, the OECD transfer pricing guidelines as well as the UNTP manual say that possibly in this situation, ARCO will need to pay a royalty to ESCO. Now, let's just say that in the financial accounts here, because you see, I have to illustrate globe stuff with financial numbers. Otherwise, the discussion just goes a bit in the air. So let's just stick to the financial numbers here. So if you just look into the financial numbers here, you see that the payment that has been made by ARCO to ESCO is 100. But now let's just assume that there is a bilateral advance pricing arrangement here, which is the case of many multinational enterprises. And the bilateral advance pricing arrangement basically says that the price that has been fixed in bilateral negotiations for the arm's length value of this royalty is $80. Let's just assume that. So what flows into the globe calculation is not what you report in financial accounting purposes, but what you report actually for taxable income purposes. So for globe calculations for country S, the denominator or the numbers which are reflected in the globe calculation of company S in country S, that's a low tax country, is actually 80. It's not 100. So you see that the numbers which you report for transfer pricing purposes, they actually flow into globe calculations, at least in situations when there is a bilateral agreement, advanced pricing arrangement in place for multinational enterprises, or even if there's a multilateral APA. Till the extent all the tax administrations agree with the price, that price flows into the globe calculations. But we know that multinationals, they don't only get bilateral APAs, but they also get unilateral APAs. Unilateral APAs, a lot of multinationals I speak to, they have tons of unilateral APAs in more than at least 50 countries. One multinational I know, 50 countries, they have unilateral APAs. So you just take the same example here, and let's say that the APA, the unilateral APA, was actually concluded only by company R with the country R tax administration. So the unilateral APA was concluded only by ARCO with the ARCO tax administration. So the question once again arises is, well, if in the financial statements you have a royalty fee which is booked as 100, but the unilateral APA in country R says the amount is 60, so what flows into the globe calculations right now is 60. But this 60 is not only taken into account for the globe calculations of country R, ARCO, but the 60 also flows into the globe calculations of company S. So even though company S in country S reports 100 in its financial statements, now why has OECD taken this position? Now why has the commentary to the OECD model rules expressed this? That why should 60 flow into the globe calculations? Well, even though, so here in this example, just to make it clear, there's a unilateral APA with ARCO with country R, which sets the price at 60. So normally 60 should be the price in country R. But here, the counterparty's income is also adjusted. Now, what the OECD basically says that if we don't take 60, the price which you report in the taxable statements of country R, for globe calculation purposes, then the 40 here is actually exposed to something known as double taxation. Now, this kind of double taxation is something different from juridical double taxation, which we all know about. It is something different from economic double taxation, which we all know about. This double taxation arises because of the intersection between normal corporate income tax rules and the globe rules. So when the two systems collide with each other, they create a third kind of double taxation. And in order to avoid this third type of double taxation, which in our example, this 40 of income is exposed to, they basically say that the amount that is reported in a unilateral APA in country R needs to flow into the globe calculation in both country R and country S. Similarly, whenever a unilateral APA is, if you take another example of a unilateral APA which is concluded in country R, and in this case, the unilateral APA basically decreases the taxable income. In the previous case, it increased the taxable income in country R. In this case, it's decreasing the taxable income in country R because the expense that is booked in the unilateral APA is 120 in country R taxable income statements. So when you book 120 in the taxable income statements and the financial accounts say 100, for country R, they say, okay, 120 should flow into the globe calculation. But on the other hand, for company S also, actually not on the other hand, for company S also, they say 120 flows into the globe calculation. So the message that the OECD is sending right now is that if we don't make this adjustment in company S, then this 20 year of an adjustment is actually exposed to something known as double non-taxation, which once again arises because there's a collision between the regular corporate income tax rules and this new Pillar 2 system. So, I think, with the numbers, it may get a bit confusing for all. I can see that. But the thing here is that what you need to know is that whenever there's intersection between the regular corporate income tax rules and the globe rules, so basically there's a difference in the numbers reported for transfer pricing purposes in the current corporate tax system, it can have spillover effects in the Pillar 2 system. And here, double taxation or double non-taxation can arise. And if you want to avoid double taxation you want to avoid double non-taxation from the collision of these two systems, then the amounts that are reported for taxable income purposes prevail. But this is to the extent the adjustments are made in high tax countries. Completely crazy now. Now, what do they say if a unilateral APA was actually concluded by the taxpayer, ESCOer, in the low tax country? Now, when a unilateral APA is concluded by the taxpayer in a low tax country, so ESCO with the country S tax administration, in this case, assume that the unilateral APA says it's 70 in the price. So the financial account number is 100, tax statements is 70. But here the OECD says, well, in these kind of situations, 30, which is the difference between 100 minus 70, this 30 is actually exposed to something known as double non-taxation. But the collision here, it actually creates double non-taxation. Now it creates double non-taxation because this 30 is actually exposed to something, to the normal corporate income tax rules in country S, and the same 30 is not exposed to top-up taxation in country S. So essentially what's happening here is because of the collision of the systems, once again double non-taxation is created. And in this kind of situation, the OECD basically says is that if the transfer pricing adjustment is made in the low tax jurisdiction, then this amount should be ignored for globe purposes. So whenever an adjustment leads to double non-taxation or to double non-taxation, then in this kind of situation, the numbers that are reported for taxable income purposes should not be taken into account. So basically, I think with the numbers, you can just see it on the slides. It will be circulated to everyone. But the key message is as follows. Adjustments made in high tax countries for transfer pricing purposes flow into the globe calculations of both the taxpayer to whom the adjustment is made plus the counterparty in the other country, whereas adjustments which are made to the taxpayer in a low tax country are completely ignored for globe purposes. So some kind of new rules have been created, which we can get into a bit detail in the panel discussion. And these new rules basically indicate that a new principle has been created. Third type of double taxation has been created, which we all can actually have an intellectual debate on through whenever the globe rules interact or intersect with the regular corporate income tax system. Very quickly on the permanent establishment side, I would just like to mention to you that the globe rules also deal with permanent establishments. So permanent establishments are treated as separate entities for tax law for globe purposes. So P's are considered to be separate entities for globe purposes. And the starting point to determine the globe income of a P is the financial accounts of the P. But these financial accounts of the P need to be adjusted. They need to be adjusted. So it needs to be adjusted, and the adjustment takes place depending on the type of P that exists. So you can have Ps that arise because of tax treaties. Now, tax treaties are different. Tax treaties are based on the OECD model, the UN model, or a combination of them. And in some situations, tax treaties use the arm's length principle to allocate profits to the Ps. In some situations, you use formulary approaches. So there's no uniform standard there itself in tax treaties when it comes to allocation of profits to Ps. Another kind of Ps are basically Ps which arise just because there's no tax treaty in place. So Ps that arise only because of national law. For example, if a Hungarian company has a P in the US, now the treaty is cancelled, or the treaty will be cancelled, or the Brazilian company has a P in the US, there's no treaty in place there. In that kind of situation, you will see US domestic law to allocate profits to a P. Then there are some other examples when you're dealing with Ps set up in no tax countries, like in Dubai, in Cayman Islands, in Bahamas, so on and so forth. And there's also something to deal with stateless Ps. But the key message here is that, as we already discussed in the previous session, is that there's no uniform attribution rules in the current international tax system. Countries use the ALP, countries use formulary, and sometimes they use a mixture of ALP and formulary. So there's no uniform standard. So facts and circumstances analysis would be required to develop or to assess the globe income of a permanent establishment. Just to give you a very simple example here, if you take the home office P, now if you just assume that there is a P and this P is engaged in the business of R&D services, let's say for whatever it reports for financial accounts, let's say it says, okay, it's an R&D service provider, that should be a return on total cost. Now let's just say for financial account purposes, it recognizes an income of 1,000. So everything is done at cost for financial accounts, because financial accounting, local accounting rules, they do not allow for markups. So let's just say it's 1,000 for financial accounting purposes. But then if the tax, but then because the way the globe rules are written, you will have to do an arm's length analysis. And then if you start saying, well, this kind of R&D service provider P needs to be compensated on a cost plus 10%, then basically the globe income of the P from financial accounts, if it's 0, it can be increased to 90 if you apply a pure arm's length analysis, depending on the treaty. So once again, the key point here is that for Ps, there is no uniform attribution standard. Sometimes ALP is used, sometimes formulary is used, sometimes a combination of different approaches. And this is just going to create a huge amount of burdensome administrative requirements on multinationals when they have to deal with permanent establishments. And actually, what the globe rules say is very interesting. So if you have a P of, let's say if there's a ultimate parent is in Japan, and let's say it has a subsidiary in Germany, and this German company has a P in, let's say, in Dubai, then basically what they say is that the entity, the P in Dubai, or the financial statements which have to be created for the P in Dubai are not the statements of the German, which are used for German financial accounting purposes. They are the statements which are actually a new kind of statements have to be developed based on Japanese GAAP. So Japanese GAAP has to be used to develop the PE's profit and loss account. So just to sum up, it's my last slide. Before I get into the pillar one for one more minute, is that what has happened is that the globe rules have created.
This is now 25 minutes. We have 1 minute for this, but we
all right.
cannot go into
Sorry.
stuff.
So yeah, so basically the key messages here is that in general, when tax administrations accept the ALP, these numbers flow into globe calculations. When tax administrations don't accept the ALP, essentially multinationals, they are exposed to higher burdensome requirements, risk of double taxation, multiple taxation in different locations. And essentially, the way the globe model rules stand right now, there's no dispute resolution provisions. So all the best to multinationals when they have to implement these rules. Lastly, 30 seconds. When we are talking about this globe income and trying to assess the interaction between TP and pillar 1. I just want to mention to you that TP rules also interact with pillar 1. Pillar 1 is something, under pillar 1 we need to calculate something known as elimination profit, and this elimination profit also has to be calculated based on the globe rules. So it's copy paste of globe rules, chapter 3 into pillar 1, copy paste. So essentially any adjustments made in a transfer pricing context also has spillover effects in a pillar 1 context for mobility related situations. With that I will stop. Sorry for exceeding the time.
Thank you, Wolfgang. Okay, we have 20 minutes left, so there is space for our commentators, and I would again start with Stefaan de Baets.
Thank you, Professor Schön. And well, to confirm what has been said, why make it simple if you can make it difficult? And this is precisely what has been doing. And if we link it to the topic of mobility, and I think Isabel Verlinden yesterday must have said it certainly as well, you need to keep track of where your staff is. You need to keep track of where your decision makers, if we can call it that way, where they are. In particular, I mean, nowadays you can have your head of research and development, where your laboratories are, for example, in Germany, where your head of research and development is in the US. It's very easy. You can actually do it now. So this is already an issue on the normal allocation issues, but it becomes even worse now that under Pillar 2, where you have this minimum taxation of 15%, where you also have to keep track of where your staffing is. Also under Pillar 1, and don't forget, if you have a transfer pricing or an allocation issue, that it can also go back within certain years. You may have to reallocate your globe profits. If you have, for example, a transfer pricing audit or something, you can have I would say, you can have to retweak, you can have to recalculate actually your globe income. The same thing for Pillar 1, although now it's only, I would say, the really big multinationals with 20 billion turnover or 20 billion revenue and 10% profitability. But still, you need to do the same thing. You need to keep track. You need to really keep track of where your staffing is. You need to keep track of where your decision makers are. One thing that has not been addressed, but I think it is equally important, that is amount B, the market state, and the impact thereof with regards to mobility. I have never seen, or at least up till now, I have not seen anything written about mobility and amount B with regards to Pillar 1. So that's something I would say, perhaps some criticism, or that is something that I would like to see addressed. Thank you.
Thank you. And now Philipp Besson.
Yeah, very, very brief. I think you said more or less everything. We built, and that your first sentence is, I just wrote it down, new rules built on an existing system. So new complexity built on complex, insufficient system. So just let's maybe say it a little bit with an easy language. We built something on which is garbage, maybe not the right word, but maybe you understand me. It's something which does not work properly, and we built something on top of that, and that cannot work. So I think that's the main message. That was maybe a little bit not the right wording, but we need to wake up and start at the bottom. And it was a perfect presentation of the complexity. Yeah, and you really showed us what would that mean and which complexity that would mean if we would implement that. And some countries have already started to implement it. So it's dangerous, the situation, I think. Thank you.
Thank you. I see Louis seems to be sitting in a car, and I hope that he will not end up in a car crash if we. Oh, so you're not yourself at the wheel. Wonderful. Then you are free to speak, and I think the taxi driver will learn a lot.
Expected double taxation in case you have a no tax. cannot be recognized globally. It's only so it brings one more already have costs. I mean, I'm curious what the judiciary in the future will say about all these rules when you talk about equality. And you say that one taxpayer shall have its taxation depending on the treatment of another taxpayer in another jurisdiction. I mean, this already was a problem in BEPS 2. This became again a problem in GLOBE. Showing that the problem is bigger now because more consequences which one taxpayer shall have from something which is completely out of his or her control because it's the tax treatment of another jurisdiction in another company. So, how do you think that the judiciary will react on the equality principle or the effects that you have just shown? This would be my question. And again, curious about judiciaries and law. Thank you.
Thank you very much. And I think the taxi will now be your PE because you have performed significant functions there, Luis. Yeah. And the only question is, of course, how much profit we allocate to the taxi driver. But again, we leave it. Well, maybe Vikram, there have been some questions. And from my side, just to clarify the situation, all the issues you raised would come up in any transfer pricing case. It's not specifically related to assigned staff, etc. The same would happen if the staff would sit simply on the premises of the subsidiary. It could be a loan, it could be a service agreement, it could be a sale of intermediate products. So basically, it's not a mobility thing. It might come up in a few more cases then. But systematically speaking, it's a general issue. Secondly, while this is a general issue, there seems to be one specific trait which your examples build on, and that's the fact that you have this unilateral APA, which means that you have no symmetry on the two sides, because in each and every case where you have a follow-up, a countervailing adjustment on the other side, the problem doesn't exist as well. So it exists in those cases, generally speaking, of transfer pricing, where you have a unilateral statement in country A, and country B simply doesn't follow. Is that correct? Because that's I think your main message.
Yes, so it's not only on APAs also. I didn't really get into, so basically I was showing in these examples the denominator of the formula to determine effective tax rates. But even if you start analyzing the numerator, you see that any kind of adjustments that are made in the future because of tax audits, so unilateral transfer pricing audits, or in a unresolved cases in a map, or even if you go into arbitration, this again has spillover effects in some situations on the denominator. And once again, you're back to the same situation, which basically says that if you're making a unilateral tax transfer pricing adjustment in one country, then that amount should not only be reflected in the globe tax return of that country, but it should also be reflected in the counterparty in the other country, till the extent the country where the adjustment is in a high tax country. But if Hungary makes an adjustment tomorrow, or Mauritius makes an adjustment tomorrow, Singapore makes an adjustment tomorrow, assuming that they have tax rates below 15%, then whatever transfer pricing adjustments are made, then those adjustments are not taken into account in the other counterparties, which are there in the high tax countries. So it's so the monitoring requirement for multinationals of monitoring these transfer pricing adjustments in each and every country and ensuring that these numbers flow into the globe calculations is just huge, is substantial. And this is somehow underestimated right now at this stage.
And wouldn't that lead to the consequence that if we have a globe group, that countries should try to avoid any mismatches here so that there is always 100% coverage of the overall profit?
Yes.
Okay, Stefan. And I invite the audience to comment as well.
Yes, precisely. And the complexity and what Vikram has said is precisely the point. But the complexity raises that if you don't have the symmetry, for example, in year zero, and you have this tax audit in year, say year 3 or year 4, that under certain circumstances you might have to go back to year 0 and do your recalculation with those effects. And this is precisely what makes it very complex, because 3 or 4 years later down the road, well, where are you? So this is what makes it extremely complex. But I fully agree. I mean, when you have these allocation issues, well, it will spill over also to the globe rules. That's my point.
Mario Tenore. You need a microphone so that Luis can understand you.
Very quick point. I have high level knowledge of Pillar 2 and I'm not a transfer pricing expert, but the discussion you raised reminds me of the position of the EU Commission in the working paper on state aids, where they draw the distinction between one-sided approach methodologies, such as, for example, the TNMM, because you don't need an EPA, to have a one-side determination of a transfer pricing of a transfer price. And two-sided methodology, I think your example would fit in this last cluster. For example, when you apply a coup, you have the recognition of the same price for the transaction in both jurisdictions. So I think you might have a look in that document, because somehow the logic behind is similar in a completely different context, but similar.
Thank you, Anna Paula, and then Aitor.
Thank you. One clarification. On the case of the unilateral APE concluded in the low tax country, that could lead to double non-taxation. And this rule for symmetry, this is related to BEPS, right? It's not something that would automatically result from symmetry under transfer pricing rules or traditional transfer pricing rules. The first group, yes, in order to eliminate double taxation and this new juridical double taxation. But the second situation that you mentioned.
Well, actually, firstly, what we are usually used to is juridical double taxation and economic double taxation. Now, this third kind of double taxation has been created. I think some clarification needs to be done on this. What is this third type of double taxation? Well, it's double taxation which basically arises because of the collision between regular corporate income tax rules and the globe rules. And well, what the globe rules basically say at this stage, the commentary says, is till the extent the collision avoids double taxation or avoids double non-taxation, then the ALP price reported flows into the other jurisdictions. ALP price should be taken into consideration. But till the extent this collision between the globe rules and regular CIT rules leads to double non-taxation or leads to double taxation, then should not be taken into account. Essentially, they try to cut a very long story short, whenever a transfer pricing adjustment is made in a low tax country, that adjustment numbers will not flow into the exactly then those numbers will not flow into the globe calculations of both that low tax country as well as the counterparty in the high tax country. So that's this kind of new kind of the third level of double taxation that has been created. Yeah, it's a bit complex, and it's not systematically applied across the globe rules. It's only discussed in the context of transfer pricing, ALP, and how it interacts with the globe rules at this stage. And actually, there's a big mismatch between Article 323, because if you just read Article 323, which talks about this, 323 basically says, well, you need to make adjustments for arm's length prices. Nowhere in the rule it says, well, if it's a low tax country, only if it's a high tax country you should make an adjustment. If it's a low tax country, you should avoid it. All that is flowing from the commentary. And actually, the UK, what they have done in the model rules they've issued is that they are aligned to the discussion of the OECD in the model rules, which you find in the discussion in the commentary on Pillar 2. It's also reflects in the UK in the UK draft rules. But like, for example, in Switzerland, they just announced a measure where they're saying we just copy paste the globe rules into the Swiss law. And then you have a difference between what is there in the rules and what you have in the commentary, and then there's a mismatch. And this is where you see the role of judges. When the judge sees this kind of case and they see there's a big mismatch, there's clearly a tax dispute. And what's even worse right now in the globe rules, the way it's drafted, there's no provisions for dispute prevention or dispute resolution. some kind of ideas are being discussed, but are those ideas sufficient? That would be the question here.
Thank you. Now, Aitor and Paulo.
Yeah, I just wanted to know your opinion, Vikram, about kind of a thought-provoking remark. I will say, in my opinion, that doesn't make sense of speaking about double taxation in the context of GLOBE, because GLOBE is all about double taxation. It is about creating double taxation. Yeah, because actually the purpose of the rule is to achieve minimum taxation. If this is achieved through the combined taxation of two jurisdictions, which is double taxation, is completely fine, right? Maybe to frame it in the context of your presentation, and I just had one more technical question, because I was thinking, if there's this unilateral, let's say, downward adjustment at the level of the low tax country, wouldn't this result in less taxes paid? And the fact that this figure is taken into account in the calculation of the determination of the spread, the top-up tax, isn't it already taken into account for GLOBE purposes?
Yeah, in one
Maybe
way.
we could have now Paolo and then one last word by Vikram.
I will be very quick, just to say that you will have even more problem in following years, because you might have a unilateral corresponding adjustment that must be sterilized in afterwards here, obviously. You might have decision by the court that reject the adjustment by the tax authorities, and you need to take into account sooner or later. And third, the fact that you don't have the rules in the rules, but in the commentary, is also creating problems in the future, because is circular reference to low tax jurisdiction, because the low tax jurisdiction is made on the computation with the tax on GLOBE, and you calculate the GLOBE income on the basis of the fact that you have a low tax jurisdiction in order to include or not include adjustments.
Thank you, Vikram. 2 minutes.
Well, just to respond to first Aitor, yes, you're right. In one way, it's double taxation, and it's a pity that honestly, the way the rules are being devised right now is that if there would have been appropriate amount of public consultation between transfer pricing people and when the drafters were making these rules, probably we could have added something. I think this was something last moment which was squeezed in the commentary. That's why the changes haven't been made at the model rules level, because the model rules were issued in December, then the commentary was issued three or 4 months later. This was plugged into the commentary because I think actually comments by PwC, if I'm not mistaken, they public comments by PwC, they asked them to take into account outcomes in unilateral APAs, bilateral APAs, unilateral tax audits, multilateral maps, bilateral maps, and so on and so forth. So they try to plug this in the commentary. But now when you start analyzing this from a research standpoint, you see that tons of issues here. And well, the level of certainty that is offered by GLOBE rules at this stage for all these issues is minimalistic at this stage. So, yeah.
Thank you. Now we are 1 minute again.
Yeah, thank you. When I heard Paolo and Vikram, I was thinking in EU. I mean, Vikram, how do you analyze, or have you analyzed the interaction with state aid in this case? Because we know from the past what happened with the state aid cases and APAs, and in the context of the US, even with American companies. I mean, this is a very important issue. I think that should be taken into account, because we cannot roll out that the commission. Don't forget that the commission, the EU law, is not a tax matter; it's a competition matter, and the commission has entered into taxation with this. So I'm not sure whether the commission could understand that any APA or BAPA could not be taken into account for this proposal. That's one question I sent to the academy. And second one, with Paulo, thanks for your presentation. I side with you completely in your views. And for me, there's one upside with the new potential directive, which is related to law. At least if we have a new directive on cell companies related to GAR national member states rules, maybe we will have new preliminary rulings on these GAR rules because of the connection between national measures transposing the directive or the EU law, because well, we have the Halifax case, which is not a direct tax case, which has been a very good reference to understand the substance and the abuse of forms. But maybe with this directive, and even with ATED 2, we have a new legal certainty, because at the end of the day, with the GARS and with the cell directive, what we will find is uncertainty. And at least if we have UK law, we can have this certainty for our taxpayers and clients. I mean, that's my view.
I think you have to get the answers over the coffee break, because this is now 4 o'clock, and Gianmarco and I think we will have to close the session now.
Yeah, sure. Well, thank you very much. I think this session leaves me at least with more questions than answers, but I think congratulations to all of you. I think you made a fantastic job. Thank you, everybody, for staying with us until 4 p.m. So enjoy the coffee, and if you have any questions, reach out to us during the break. See you later.